Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're active, passive, just curious, or you've been in the industry for decades, well, we built this YouTube show and podcast especially for you, breaking down all the latest research reports, articles, the good, the bad, the confusing, every single week to try to help you make really informed decisions in the multifamily industry. Great reports today from CNBC, Federal Reserve Bank of Cleveland, Fannie Mae, Rent.com, and also a release of the Gray Report National Rent Tracker. Matt's got some updates for us. Excited to get into it. We're getting into the new year. Merry Christmas. Happy holidays. All right, let's get into the report. Welcome to the Gray Report, joined again by co-host Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt, how things going?
It's so remarkable how things just keep happening.
The world keeps spinning and the sun keeps shining.
And you know what I thought was interesting about this week was, as much as there are consistent economic worries, things haven't seemed to get sharper or more concerning, at least over the past week.
I think things are looking a little bit more opportunistic, even though I think 2023 is going to be a bumpy year. But I'm looking forward to it because I think whether there's going to be opportunities in 23 or 24, there's going to be great opportunities at some point, and so it's worth keeping an eye on the ground.
If I did do a YouTube thumbnail audit, all of the alarmist YouTube channels, a couple weeks ago, and maybe even sooner, and honestly they do it every day. There's disasters happening, but now every so often you're gonna see, this is the best buying opportunity in decades, ever.
People are so used to and numb to the doomsday.
Yeah, well, I mean, nothing's going to make you click more than the end of all.
But now all of a sudden it's like, somebody has a positive opinion about the future of the economy, like
a nuclear bomb of an opportunity. That's what people want to.
That's what's gonna. Yeah. Well, that's why I asked the AI or generator to make a happy nuclear war, and the outcomes was kind of interesting. Very so. But it's fascinating because the market right now, we're still far, buyers and sellers are still far away, and part of it is adapting to the new realities economic that we're living in, and I think we're in a higher inflationary environment. I don't think it's going away. I think inflation's going to be coming down, but I don't think it's going back down to 2%. And so getting out of the the positions that we were in the way you would look at the market back in the past 7 or 10 years of low inflation and low cap rates and low interest rates. And one trend that's happened over the last really since 2010 or so is cash flows of multifamily properties returns, not necessarily total returns, but cash flows have been going down and down and down. I mean, it used to be that you wanted to see high single digit cash on cash return in the first year of operations, but it wasn't uncommon to be getting double digit. You could get 10% cash on cash year one or year two. I mean, the cash flows historically were much stronger. I mean, you go back and look at the 70s and 80s. Those cash flows are really strong. Now you had to hold on to the property for a longer period of time because what wasn't there was the appreciation. Yeah. The cap rates are much higher, and so it was a much longer term play focused on cash flow, which we've always been focused on cash flow, but I think we're returning to that. And because the reality is, the discount rates have changed. We're in a real yield environment where bonds actually are yielding something, because past years, it's like, what was the point of bonds besides some weight and balance to your portfolio? I mean, they've been performing horribly, but they also had been yielding next to zero. But now all of a sudden, you can get 4% out of a treasury bond. You can get 6% out of municipal bond. You can go to high yielding corporate debt, can B grade, and you can maybe get 9%. And so for a multifamily, it's cash flows for multifamily property should track closer to that kind of corporate debt yield. because you're getting more return on a multifamily investment because it's equity and you have upside in addition to that, but you want to be paid while you wait. And so the times of, accepting lower cash flow, 5%, 6%, 4%, 3%, or no cash. I mean, there were groups in the last couple of years doing deals with no cash flow, negative cash flow. It's like, well, it's going to appreciate. We're going to sell it for a lot. And that was successful for a period of time, but that's just not the world we're living in right now. And so you've got all these sellers who need to sell, and they really don't like the idea of selling at high cap rates.
Yeah.
But that's just the reality. And so the spread the gap between buyers and sellers, the bid-ask spread has narrowed. It was maybe, 150 basis points, cap rates maybe at 4.5, and people were like, I'm more at, high 5, 6 cap. Now the brokers and sellers are closer to 5, kind of 5.5, and, the market's closer to a 6. And a year ago, to say to a lot of multifamily operators, cap rates are going to be close to 6% when they were at 4%. That's hard to process. And they don't want to believe that. And a lot of them still don't want to believe that because their buddy sold a deal for a 4 cap a couple months ago. And now like the offers come in and it's, mid high 5s and 6s. So it's going to be interesting when there will be a point where buyers and sellers are meeting in the middle. But we're not there just yet.
I bet that moment will be the shortest time period possible.
Yeah, and then I think cap rates are gonna go down within a range depending on inflation.
But that will be. I mean, there are already people that are tracking loan maturity and when things are coming due and which have floating rates and all that kind of stuff. But this will probably reward a little bit of like a minute focus on whatever your market is and a good relationship with brokers
and just so on that topic of just different environment, different world than the last decade or 2 decades, and adapting your strategy. One example of that, and it's a little wonky, and it's kind of at first it was hard to connect the dots. But talking about this news out of Japan this week of where Japan is changing their yield curve control policies, and if you know what the yield curve is, it's basically the different rates and maturities of different bonds. And so, historically, the longer maturity of a bond, and we're talking about government bonds like, U.S. Treasuries, the longer you have your money tied up, the higher the interest rate that you're going to get paid for having your money tied up. So it's like, I'm going to wait for 10 years. I should get paid a little bit higher coupon than 1 year, 2 years.
You were talking about how Japan seems to manually dial this in.
Yeah, they put
why doesn't
collar.
Now I'm going to portray my lack of knowledge of the bond market. Why doesn't the U? I mean, if it's a U.S. bond, why doesn't the U.S. say?
No, we're not talking. I'm just talking about government bonds in general and yield curve. But so every country issues their own treasuries, and so this is not for U.S. bonds. This is Japanese bonds.
Yeah, I know. I was just kind of comparing it like.
Why doesn't the U.S. do yield curve control?
Yeah, or why don't they? Yeah, exactly.
Well, so that was a big debate back in 2020. People thought that the U.S. was going to start instituting yield curve control. And they do in a kind of a backdoor way if buying U.S. Treasury bonds, if they're a big buyer of Treasury bonds, they can move the yield and the price up and down. But they don't have like a set policy of we are like the Federal Reserve doesn't come out and say we are trying to have the 10-year be in a range of 3.5% to 4% like they do in the Fed funds rate, and they set the Fed funds rate. But Japan does. They say we want the 10. So it's been like negative for a long period of time. We want our 10-year Treasury to be between negative 1% and negative 50 basis points.
And this is because
Japan is a very mature economy, very slow growing. So they've had deflation for decades. Okay. They've had declining population. They've had a very old population that's not very productive. And so it's been an experiment, the past couple of decades of having, they have the loosest monetary policy, in the entire world. And, quantitative easing, just, the money printer has just been going off because they have so many deflationary forces that they're like, we'll just throw money at it because, we don't have any more land to build, and our population's getting older. We don't have to worry about inflation, so let's just print money. And so they've been doing that for the past couple of decades, and so they want their cost of capital to be as low as possible, so people continue to invest in Japan. You can do projects in Japan, but even so, the point of all this, why we're talking about it, is that for Japan to now say we need to move our range of our 10-year bond to a higher range means that they're facing enough inflationary pressures where they see that for an extended period of time we're going to see higher rates of inflation.
Yeah.
And it's another symptom of the global economy transitioning to a era of higher real yields and higher inflation, and that because we live in a connected global economy where asset classes are everything's correlated to some degree. Some things less, and some things more. Private markets, public markets. But the yield on real estate, commercial real estate's a big business. It's the hyper local, and it can get incredibly granular, but it's still connected to Japanese tenure in some way in the global economy. And the Japanese yen is very important, just global benchmark in currency. The dollar yen pair is very important in forex and just global economics. And I'm not an expert, but just knowing that they are all very much interconnected, and we're seeing the entire global economy shift to this higher yielding environment. And that's why I'm saying for multifamily properties, not accepting 5% cash on cash or 6% cash on cash or even 7% cash on cash. We need to see a higher yielding. We need to see appropriate risk premiums because of the higher discounted rate and the higher yields in other alternatives for investment that produce yielding cash flow. It's bottom line. It's a numbers thing. And I look at this, and this could be there's some great capital in maybe another firm of where the firm just doing deals. We need to do deals because we have to get fees and all that, and that's great. But if you look at it from an investor standpoint, and not just I want to invest into apartments, but I need to allocate my capital, my resources in the most efficient place possible. You need to have the appropriate yield and returns, and that's why we're driving the owners that we're talking to and brokers that we're working with of this is where pricing needs to go. And we're a buyer, but it has to be relative to the cost of capital and global economy.
And maybe so then if it was a different situation, maybe if interest rates were not as high, you would adjust that strategy, or
well, if interest rates weren't as high, we'd be able to get higher yields. And with inflation, with growth, which the rate of growth it's pretty uncertain right now. I think we're seeing a decline in rent growth over the last couple of months, but that's correcting off of 2 years of incredible growth. I think we probably have some pent up demand. I think the housing market's probably going to pick back up in, 24, 25, and it will include the rental market. So it's right now we're in a phase of price discovery. And I think that our compass, our section has to be, pointed towards higher cash flow. And looking back not too long ago, again, a couple of years ago, where cash flows were. And everyone's gotten used to, 6% cash on cash. Well, we need to be back to the 8%. For the longest time, 8% preferred returns, that was, pretty standard pref hurdle in private equity and multifamily. Wouldn't do a deal that couldn't hit that 8% hurdle. We didn't even want to accrue any pref. It's hard to realistically do a deal in the last 2 years that would throw off 8% when we've done it, multiple deals. But to get 8% year one, it was tough. You could do it, but it's hard to project without just speculating a lot. So I think we're reverting back to a time that it'd be somewhat familiar, and there's going to be folks that are stuck on the short-term high IRR investment thesis that was very profitable the last couple of years. And who knows? But I think that's going to be tougher to do going forward.
Well, what I was trying to get out of you is, there's, it's like, I'm sure that we're adapting, right, to different situations, and it's not a one size fits all. Maybe it doesn't pay to always think about it like a long term mindset. Yeah. But I bet that there is a threshold beyond which, like, you don't want to get too short term, even if going's great, because you could find yourself in a big problem.
It's like I always think of it as musical chairs. Like it's like it's fun, it's a good time, everybody's dancing. Yeah. And then the music stops, and it's like someone's getting screwed. Yeah. Like not everybody, but like you don't want to be around the music stops without a chair. Yeah. So but I wanted to mention again, it's like not hardcore multifamily related, but I thought it was it's just another piece of evidence and touching on the global macroeconomy.
Yeah, for sure.
So again, the Bank of Japan caught markets off guard by tweaking its yield curve control policy to allow the yield in their 10-year Japanese government bond to move 50 basis points either side of its 0% target. Again, it's very loose still, 0%. But,
and all of the experts cited are like, this isn't a big deal. Don't worry about it. But the market's reaction is a little bit
because again,
a little bit worse.
Exactly, because they're adjusting to that discount rate and seeing yields go up, and I think it's maybe more symbolic of where things are going. And again, another just piece of evidence than anything, or not necessarily negative. It just kind of is. It is what it is.
Yeah.
All right, Matt, where do you want to go to next?
There's a really interesting working paper from the Federal Reserve Bank of Cleveland, and this may be one of the cases where I may suggest there's a recent Bloomberg article that summarizes it a little bit better, because the paper itself is heady and abstract. It's like even the headline, even the title is like
disentangling rent index differences, data methods, and scope.
Yeah, I think it could use a little razzle dazzle. I thought.
How do we pick a title where people aren't going to read it?
Yeah, inflation bombshell. This one weird metric is off by an entire year. Or like Fed quietly develops a new inflation measurement.
This one trick that the Federal Reserve doesn't want you to know.
I've been baited into the word when they use the word quietly. I'm like, well, what are they quietly doing? I need to know.
Quietly, just
Yeah. But yes, okay.
Maybe that's why they know.
Yeah. So the metric, this inflation metric, is rent, of course. And while this is a working paper, it has the depth and rigor really to signal that this.
That means they're still working on it.
Yeah. Well, yeah, they've done a lot of work already. That's for sure. And it does. And you need to do a lot of work to kind of grok the some of the figures and ideas that they lay out here. Definitely signals that it is. Definitely signals that it is like that some smart people are really it's an academic style paper. It's got they've got weights to different rent measurements. They're referencing appendices. They have 6 decent footnotes in the first 3 paragraphs. So
have we not copied all this and dumped it in the chat GPT?
Not yet. Right. I did have a thought. It's like I was mostly finished with it. I was like, you know what? No, it's fine. Yeah. I don't have the means to determine whether like the article itself is like 100% valid, but I trust it. Stylistically, it has the look and feel of a scholarly paper, and it should be noted, and I think I've noted this, I've alluded to this earlier, that part of the look and feel of a scholarly paper is that it will feel almost intentionally opaque. Most of the time, that's on purpose. In order to get your paper published in academic journals, you need to make sure that it bounces off, it just bounces right off the understanding of 99% of the people reading it. If the peer reviewers can't understand the paper, then that's like an instant publish. Yeah, that's just my exaggeration there. The big issue that the authors are dealing with is the difference between the CPI measurement of rent, which comes from the BLS household survey, and other measurements of rent like Zillow and CoreLogic that are a little bit more closer to market rents. We've thrown some shade on the CPI's measurement of rent growth before. Just last week, I was comparing it to a dinosaur fossil because of its lagging indicator. This working paper clarifies the CPI rent measurement such that it's not exactly a lagging indicator, and it's not really the product of an antiquated methodology as much as one that just may not be as sensitive to the same inputs as other rent measurements. They say that the CPI's rent measurement is fully representative of the rental housing stock in U.S. cities compared to the Zillow and CoreLogic measurements. And the Zillow and CoreLogic maybe draw from a restricted number of cities. It doesn't, it limits themselves on the types of housing that it tracks. And there are other things and other weights that aren't applied to these kind of private rent trackers that the CPI is updating, and they are kind of like putting some real work on there.
So should this really be called like in defense of CPI?
Well, it kind of is, and maybe it's because they are striking a very disinterested, unbiased
it's
tone.
been under attack. I mean, by not just people in the housing industry, but I mean, housing has been spoken more and more in just that macroeconomic conversation, and with CPI being such an important market mover and housing making up 30% of that, it's like, what are we actually looking at?
That's a really great point. Is I don't think the argument should necessarily be about like the CPI is using like old or bad data. They're just the real difference is are they measuring the rent growth for all renters, or are they measuring just new renters?
Yeah, and that's where we bump. Or that's where the different metrics kind of bump into each other. We're looking at market rate versus just kind of your average, like effective rent.
And honestly, like this paper almost makes an implicit argument that like, let's carve out another line in the CPI report. I don't care if you have to make a new core line graph for CPI, but the weight of rental housing.
And then weight them with each other and have them each be a subcomponent of rent.
So I mean, there's ways to amend the CPI to reflect the movement of new leases rather than the existing lease, which it is a lagging indicator. The stakes of this argument, which I really think that there are big ones, and that they always, when I was trying to submit academic papers, they would say like, "Oh, what are the implications? What are the real stakes?" And they're big ones. If the Zillow reading, they say, were to replace the official CPI rent measure, the 12-month headline for May 2022 would have been 3 percentage points higher for rental housing inflation than the CPI reading. These are consequential discrepancies.
But that would have been interesting because it would have been would have like the Federal Reserve tightened more aggressively and not been caught so flat-footed if they were dealing with a more real-time indicator. Yeah. I mean, but you're absolutely right. I mean, the implications would be huge, and whether we would be in a good, better, or worse spot is interesting to think about.
Yeah, and that's like my big question is, obviously the Federal Reserve knows, and the people that are involved there, they're aware of the drawbacks and the quirks of the CPI report, or at least they should be, because there still is, when you see that number, your instant thought isn't like, oh wait, no, I got to do that adjusting. There's a psychological effect, however mild it may be, even though Jerome Powell has referenced that it's a lagging indicator.
And there's consistency going back, and that we've always made our decisions based on this. And although the Federal Reserve looks at like PCE sometimes more than CPI,
so my big question, and then very generalized for whether it's Federal Reserve or whether it's other organizations and businesses, whatever, that are making decisions based on inflation is, are there specific actions that are triggered by the CPI that maybe don't need to be triggered because we should be tracking rental housing in a different way? Yeah. We looked at the weight of rental housing and housing in general last week. It's like a third of 36%. So it's huge, and the question of are we going to track new rents or existing rents is a big part of that. My thought is that the CPI's measurement of rental housing is an accurate measurement from the perspective of the cost burden of renters at any given month or period, but it does not represent the perspective of the marketplace where the decisions about prices are being played out. So for the most part, people make their decision about rent once a year. They see the pushback, they get the feeling things are too expensive, they're determining things Once a year.
Yeah. It'd almost be like taking like what's your average spend on gasoline throughout the year.
Exactly. And they're only making it once. Yeah, exactly. Like, let's pay for all our gas once a year.
Lock in a price.
Or you lock in a monthly payment.
Or you have to go back and you'd be like, okay, what have you spent on gas like every week for every 2 weeks for the last year, and then we'll take an average, it's like a rolling average or something.
Versus prices that are negotiated or that change every, if you're paying at the pump. Instead, if you do it every time you pay the pump, then that's a lot different. And it almost is like it's 12 times less.
I wonder if you could sell. I mean, obviously, gasoline futures absolutely exist, but like on the consumer level, I wonder if you could pay a premium to lock in.
Like a subscription
price.
model. That would be cool.
Like you lock in.
You already get a little discount for the BP card or
yeah. But I'm talking like locking in your price.
Yeah.
Like if gas is cheap, you could buy like 1 year, you could lock in, pay a premium.
Ooh, I do that on like at an ad hoc level, just fill my tank more when it's cheaper. But but that's a really good idea.
Do it for a year, or I don't know.
All right, if someone has already solved this problem, please lay it in the comments and explain.
Some of that could be helpful for markets, but I don't know. Maybe.
But back to my thing is like, yes, okay, so you're paying for rents every month. They have a little less agency on the feedback every time you're paying rents for 11 months out of the year. And so if you're renewing, it also muddies the waters a little bit since you're not picking between two different apartment units. You're kind of weighing the cost of moving, and the landlord is weighing the cost of getting a new renter to replace you. And in as much as two apartments are able to be compared to each other, having pricing decisions based on the choice of one newly rentable apartment unit versus another newly rentable apartment unit seems like a cleaner comparison. So like if you're just doing that, if apartment rent was again like gas prices, then the CPI measurement of rents would make sense. But if you want to get to the closest closest measure of people's decision making of both landlords and renters. Landlords thinking, oh man, things are too expensive. Maybe you got to dial it back because I'm getting this feedback. Or new renters thinking, oh, this is too expensive. Maybe I got to go somewhere else. Then go with new rents. And I think that communicates inflation because we're dealing with marketplaces here where, wallets and people's savings and people's impact is one way to look at it. But if you're making monetary policy decisions, I think that you need to get as close as you can to decisions.
And do you expect, Matt, the Federal Reserve to change, the way that they are calculating rents in CPI? That this will, I guess this may be a first step in discussing it.
Yeah, I think it is. And this is originating from the Federal Reserve Bank of Cleveland. So I'm thinking at least they're they have the ear of someone, and there is some institutional impetus to
somebody
to
at some point
this.
Was like, we need to look at how we're
they're funding whoever's writing this. And to wit, the authors of this study have actually made their own rental trackers. A couple of them in the spirit, I think, of the Gray Report National Rent Tracker.
Yeah, which is really kind of the more of the leading source. And actually, there's been some speculation, Matt, I don't know if you could add any color to this, that the Federal Reserve Bank of Cleveland may be kind of just following in report's footsteps, seeing what we're doing.
You can read between the lines, and there are a lot of lines to read between in that report.
It's almost like a little too bit of a coincidence.
Too cute by half.
But I think, Matt, and this is great. I love this because this is really just a quick, short snapshot. July 22 to November, but you see every single source tracking downward for rent growth. Besides CPI, CPI is moving in the opposite direction.
Yeah, and if you look in some of the charts that are in that working paper, you can see similar, like an echo effect almost.
Yeah,
and actually that's kind of where one of the better parts of that study is. It's on page 21 of the document. The report shows more at a glance. They have these figures 1 and 2, more at a glance than I can describe with piles of paragraphs. it covers the ACY marginal rent index, which is really like the most volatile one, and they don't discuss it at length in the paper. But I am really interested in the comparison with Zillow, CoreLogic, and the CPI measurements as a basis of comparison. It's a little more interesting to see, for instance, how noticeably CPI lags the other rent measurements, or how much the Zillow index jumped in 2021 compared to the other trackers. And in Figure 2, they actually directly compare. I'm sorry, it's the Figure 2 of that first page. They directly compare the all tenant measurement of rent versus the new tenant measurement of rent, and they have that CPI as a baseline. CPI is supposed to be its rough equivalent, but you can see how this working papers metric of all tenants actually leads it by just a little bit, by 1/4. So that is what they kind of determined, is their new tenant repeat rent, which is one of the working papers created metrics, is about 12 months ahead of the CPI measurement. And their all tenant, which is supposed to be the same kind of measurement as the CPI, it's 1/4 ahead of the CPI. Really, really interesting, and I do think that you identified maybe probably the most significant implication of this development is there might be some movement, and there might be some increasing consideration among Federal Reserve members that we gotta stop looking at this old rent stuff.
Yeah.
But that's just my opinion.
I think it's definitely in the conversation, and it's it's kind of a seller's fact.
Yeah, I keep
running
into this.
71. All right, Matt. Let's get into this report from Fannie Mae. Fannie Mae. What's going on over there, Fannie Mae?
So the Fannie Mae, and you can click on their multifamily market commentary. Every month in this commentary, they pick a different development, a different aspect of the multifamily market. Sometimes it's a general overview, but a lot of times, like one month they did construction and renovation. But this month in their commentary, and there's a link to the PDF in the link that we'll provide. This month they cover some kind of demographic shifts. And honestly, when I think about the long-term prospects of the housing market, and really of housing in general, I keep coming back to this idea that we are on the verge of some enormous demographic shifts. And yeah, this shift isn't going to be felt, and is not being felt like someone flipped a switch, but even gradual changes are going to have a big impact, especially when we're talking about baby boomers. In the 10-year time span, again, these are talking about baby boomers, but in the 10-year time span they cover, I've been thinking a lot about shifting numbers of the 18 to 34 cohort. Around the end of this decade, maybe we could see a dip in apartment demand correlated with lowered birth rates during the Great Recession. Yeah. This possibility has been noted in some long-term projections. I haven't seen some, but it's been included in a number of different factors that are projecting what property values or the multifamily market or housing demand, or really the last time I heard it mentioned was like colleges are getting a little bit scared of what's going to happen in 8 years when all of these kind of recession era people are coming of age and demand really drops off. But I think that could that's the same kind of age demographic, maybe 4 years younger, whatever, as apartment demand. I think the jury is definitely still out on that, and it may be a marginal difference, if any, because I was looking at birth rates, and it doesn't seem like there is a clear, dramatic drop-off during the Great Recession.
Wasn't there kind of a change in that that story recently where actually birth rates kind of surprised to the upside?
Yeah, so during the pandemic there was a little bit more of an increase in birth rates, more than people predicted. So depending on how you slice it, things could go differently, but it definitely is something I'm thinking about how and the millennial cohort is bigger than Gen Z, and that following cohort after Gen Z, that may be a little bit smaller still. So we're still kind of dealing with a little bit of a mystery and a little bit of an echo, the reverberations of the baby boomer generation. I said, any change related to baby boomers are almost always going to be more impactful than piddling Gen Zs or Gen Ys or maybe even Gen Xs, which
They
my
always get
favorite
left.
generation.
They always get left out.
That's why I love them the most.
They're just doing their thing.
Yeah.
You know.
Oh man. So I just wanted to kind of return to baby boomer what the point is that they're making in this commentary is the implications of growing numbers of baby boomers, specifically a growing population of over 75, which is going to be different in every state. And they kind of talk about how, like, in some places, especially in Florida, some markets in Florida, like in Sarasota, are significantly higher proportion and higher proportion now and higher proportion in 10 years of 75 and over.
Yeah.
Now, I've heard that, like, snowbirds, they come down and then they go back for their waning years, but maybe
at some point, well, then you kind of have to go back because you need to be closer to family.
Yeah, to like kind of support
and
systems.
just moving around a lot. But it's going to be over the next 10 to 15 years. It's going to be a dramatic change just to demographics and the economy of. In so many different ways, from wealth transfers from one generation to the other, to baby boomers selling small businesses or large businesses, to moving to retirement or back home to be with family, to just less people. The largest demographic, the second largest now, I guess, to millennials, are just if they're not already out of the workforce, which we already saw an acceleration of that in COVID, but there's going to be a lot more exiting the workforce over the next couple of years.
Well, and I think too, the implication they directly point to is senior housing, whether it's like a skilled nursing facility where it's really kind of plugged in as a nursing home, or it is gradations of those communities.
A lot of different options, whether it's just 55 up and
that's
assistance. But
that's something I've really been thinking of too. Is like maybe apartment is going to go down, but it's almost certain that senior housing demand
or demand from senior citizens at apartments.
And that is true. But the Fannie Mae article really specifically singled out senior housing as this area where we're almost certainly going to see more demand. And what's interesting is that, like, I've heard this story for the past really like 20 years. It's like it's coming.
Silver tsunami.
And then, like, it hadn't come with the strength. I think there's aging in place. I think that baby boomers are eternally youthful. They're babies. They're always babies.
Oh yeah. It's like exactly.
So there was a cultural shift. I think that coincided with the aging of baby boomers that maybe are a little more independent than previous generations. But I still think senior housing is a really. Well,
there was some overbuilding of senior housing, kind of anticipation, and it was like they weren't filling up because.
Oh, interesting.
But the availability is there, and so I think it's going to have. I think senior housing could be one of the stronger performers over the next 10, 15 years for sure.
Yeah.
All right, Matt. We've got one more report from Rent.com.
I snuck in a little rent report as a Christmas gift.
Christmas comes early on the Gray Report.
That's right.
For another rent report. Matt, take this away.
Not necessarily because we have to cover every single rent report, but I did want to throw in, we mentioned our national rent report tracker, and I will say a couple of admissions that I want to foreground here about the Rent.com report. Number one, it's recently dawned on me that the company, that Rent.com, styles itself as Rent, like it spells it capital R-E-N-T with a period.
Interesting.
Am I supposed to just call it Rent? Am I supposed to call it Rent. I'm not going to call it Rent. I'm going to call it Rent.com.
Yeah, it's like 90. It's like late 90s .com bubble.
Yeah, I just. All right.
Chewy.com.
I'm a little confused. I was just a little confused.
There aren't as many websites that we refer to as .coms anymore.
Yeah, I know.
I'm trying to think.
I was talking just yesterday about how the early 2000s trend was to eliminate vowels in the names of your tech companies. But I'll stop wasting everyone's time there. The top line numbers that you may have seen just now, the year-over-year rent growth is at 7.45%, and month-over-month rent growth is at positive 1.23 for November. An uptick compared to the previous 2 months of negative growth. A new feature of this report looks at how many markets showed positive growth for both month over month and year over year. For November, for the month of November, only 39.5% of markets showed positive growth. And for year-over-year growth, a full 88.37% of markets showed positive yearly growth. Maybe last week you asked, are these guys just cherry-picking rent reports that highlight the strength of Midwestern multifamily markets?
It's just the reality.
Yeah, and maybe this week I'll look at the corroborate. We've got corroborating evidence. Rent.com has Indianapolis at number 3 for rent growth, 15.8%, followed by Cleveland at 14.9%, and Cincinnati is at number 10, 9.2%. And they also have the some of the markets with the lowest amount of growth, and Midwest is not doesn't have that big of a presence in the shrinking markets.
Nope.
It's interesting to note that in terms of the month-over-month declines, Oklahoma City, which is at number 2 for yearly rent growth, it's experiencing a little bit more of a monthly decline. But that's something that Rent.com has consistently reported on that's not included in other reports, which is that Oklahoma City is a very strong multifamily market as far as their reporting is concerned. So. A really interesting development. Another underline to the strength of the Midwest, and even places like Raleigh, North Carolina. That's consistently a strong market.
Oh, yeah.
But it's continuing to perform. So it's not like the Sun Belt's going away anytime soon.
No, and that plays into that baby boomer story. People moving to a little bit warmer weather. I mean, you have one, winter. We're going to get ready to have, bomb cyclone or whatever. And might be nicer in Florida during this time of year.
That's true.
Yeah.
Yeah. Flash freezing. That's another term
Flash
that we're going to have to deal in like
freezing.
2 days.
Any fun holiday plans, Matt?
No, but I have been. Well, yeah, we're going out, hanging out with family. It's gonna, I'm looking forward to, just to spending time with, with my brothers and sisters and all their kids, and I'm probably losing my mind a little bit. So
yeah,
that'll be fun.
Yeah,
my parents have a nice sledding hill, and I'm gonna ice the heck out of that thing.
A water main broke by my house.
Oh yeah.
Yesterday, last night, we were driving down, and there's just water flowing down this hill.
Oh man.
The street was closed. On Kessler.
Yikes! Oh man.
Yeah.
Our neighbor had that happen a couple weeks ago, and we heard it. Yeah.
Well, if you're not subscribed to the Gray Capital YouTube channel, you need to be. Whether it's on YouTube or you're getting our podcast, we appreciate it. If you're an accredited investor looking to allocate capital with a team with a little bit of experience and a track record into multifamily apartments, hop on over to Gray.fund. Love to have a conversation with you. We can learn a little bit more about what we do. We'd love to learn about you and what you're doing as well. So from all the folks here at Gray Capital, the Gray Report, Matt and myself, wishing everyone happy holidays, happy Hanukkah, Merry Christmas, Kwanzaa, whatever you celebrate. Hoping you have a good time with family, friends. Good tidings to all, peace and love on earth, in silent night. All right. Thanks, everyone. Have a great day. Catch you on the Gray Report next time.